Well, good afternoon, or good evening, or good morning, wherever you are checking in from. Welcome to TradeStation. We have a very special event for you today. In this presentation, veteran trader and educator Dan Gramza, the president of Gramza Capital Management, is going to talk to us about a simplified trading strategy for trading 6 industry sectors and 21 different markets. He's going to explain what's happened to date in 2017 because, yes, we're right in the middle of the year, aren't we? Where he'll talk about where we're going and what as he examines all the various stock index, forex, interest rate, metals, energy, and agricultural sectors. So whether you're new to trading or you are an experienced trader, Dan's going to help us get some new tools and look for some new opportunities to trade. Our presentation is for educational purposes only. All the symbols and all the trading ideas that we discuss here are for demonstration purposes. They are not recommendations. Our presentation is not a solicitation or an offer of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Remember that active trading is not suitable for everybody, and options trading carries a high degree of risk and may not be suitable for all traders. Please read the disclosure information in the PDF handouts that I have posted in the chat panel regarding risk disclosures for options, futures, and all the other various asset classes. Dan has provided us with a futures trading disclaimer. Remember that futures trading is not suitable for all investors, and it involves the risk of loss. Trading does offer the risk of loss to us. Futures are a leveraged instrument because only a percentage of a contract's value is required to trade. It's possible to lose more than the amount of money that you have deposited for a futures position. So traders should only use funds that you can afford to lose without affecting your lifestyle. Welcome to the new TradeStation Knowledge Center. We have a brand new education center that, if you've noticed our new website, if you can navigate, find your way to our Knowledge Center, we have Welcome to Futures, Products section, and a Trading Insights section where we cover each of the asset classes that there are futures products. So we want you to get started trading futures with TradeStation, and we have offer you a new section in our TradeStation website Knowledge Center. I mentioned that Dan has been around for a while. He's got over 25 years experience in trading futures, options on futures, stock options, and cash markets around the world. He started on exchange floors. He trades from upstairs. He has experience with scalping, day trading, swing trading, and position trading. He's been an expert witness in U.S. federal court. He has helped set up prop trading operations, the co-inventor of 2 issued security patents, and the co-inventor of a 3rd security patent, which is pending. He's worked with traders from over 36 exchanges, 450 institutions in 35 countries. Let's talk to Dan Gramza right now. Dan, welcome to TradeStation.
Well, thank you very much, Don. Hello, everyone. It's great to be with you. Don mentioned, this mid-year point where we are in the markets is kind of an interesting point to look back and see how did we get here and what should be our expectations as we move forward in time. So I'm looking forward to exploring a few different ideas with you as well as some different markets. Um, One of the things that Don mentioned is my background comes from a floor point of view, and it's reflected in how I look at the markets and what I'm looking for, the clues that I find helpful for me, and hopefully you'll find helpful as well too. Uh, let's let's start out by looking at a technique that we're going to be using uh, as we look at these charts, and I call it behavioral Japanese candle charts. Um, Now, for many of you who are familiar with candles, uh, what I'd like you to do is just put those ideas aside just for a bit while we're in here, because the typical approach, as you know, for those of you who are not familiar with candles, is that we go through about 80 different candle patterns. Well, I'm not going to do that. There's nothing wrong with that approach. And when I first saw Japanese candles, that was in Japan at Bank of America. I was teaching a course on another technique, and a part of the course is we went into the dealing room and identified trades in 30-year treasuries. The course was for customers of the bank, Sumitomo Bank, Daiichi Bank, and so on. And so anyways, I found some trades. We put those on. I'm walking out of the room, and there's a gentleman sitting there drawing these Japanese candle charts. And I had never seen those before. So I asked Kuno-san, the gentleman I was with, I said, what are these? And as he was kind enough to talk to me about them, what went through my mind is what I'd like to share with you. And that is it's the dynamics, or what I'm calling behavioral aspects of a candle. What is the story that it tells us? Because charts, no matter what chart we look at, is like the EKG of the market. It gives us a measure of how the market's absorbing information and the clues of what we possibly can expect in the future based upon current action. Not trying to predict the markets, but we're looking for clues to give us an idea of the opportunities the market gives us. Because I think as a trader, that's our job. Identify the opportunities the market gives us, not what we want from the market, but what it provides us with. So with that background, let's take a look then at these candle charts. Now we use four prices, the same four prices you have in a bar chart: open, high, low, and close. There's nothing new price-wise. What is different is how it's packaged and how you interpret that package. Now they draw a box between the open and close. Now I have this as green. The traditional color is red, actually red for an up close and black for a down close. And I remember when I came back from Japan, I was doing these charts by hand. In fact, I just had a flashback of sitting on the L drawing these candle charts. But anyways, I thought in our country, if a company is in the red, it usually is not a good thing. And if a company is in the black, that usually is a good thing. So anyways, the colors I'm going to use today are red and green and red. Red's a very positive color in Asia, but that's just a little background. Now let's talk about this construction. Here, because it's green, the closing price is at the top of this candle and the opening price is at the bottom. And when you have that, it creates this body of the candle. I think it represents buyers coming into the market. So for me, it's a barometer of that buying. Is it enthusiastic? Is it committed to this market? Or is it backing off? And the size of this body gives us that relative measure of the convictions that we're seeing from those buyers coming into the market. Now, why do I say it's buying? Because if you look at a chart, it doesn't go straight up. It goes up and down and moves back and forth as the day progresses. Well, here I'm saying that this market represents buying, because imagine at this low price that the market's trading at 50. And you can imagine we're on the floor or we're trading on a screen, but we're all trying to buy the market at 50. And let's say there's 100 people trying to buy and 25 people willing to sell. Well, 25 of those buyers are going to be taken care of by those 25 sellers. But for the buyers remaining, for them to get the price attractive to bring in more selling that will take the other side of the trade, we know what they do. They raise their bid. So the market's trading at 50 and you raise your bid to 51, you get filled. I raise my bid to 52, I get filled, and so on as the day moves back and forth. And we can see the market goes up and it comes down as people take profits throughout the day session. But at the end of this period of time, we're trading at 60. Now, why are we trading at 60? Because net, more people wanted to buy this and sell it. Now, on the floor, and Pete has a floor background, what you would see there is you get to see the order flow by demonstrated by voice and by hands. And the brokers would stand at the very top of this uh, low pyramid type shape. In other words, steps that moved up to the upper edge of this pit. And that was a hexagon type shape typically. And in New York, they would use rings for some markets where you stand outside. But the point is that you would see it. And you and I don't have to be down on the floor to see this. What we have to understand is what this represents. And I believe it represents buying pressure that caused that market to move higher and close at its highs. Now, it's just the opposite on the other side. Here we're seeing the closing price below the opening price, and I think that represents selling. Sellers competing against each other also drives prices lower. Um, you see that in real estate. If you were going to sell your condo or a house or a car, anything you really want to sell, you gauge what the market is right now. If you're going to do this on eBay or Craigslist, you would see, okay, where is the market for this particular item? I want to sell this. Everything else is priced at 100. I'm going to open my opening price is at 95. And you compete against other sellers, and that may drive your prices lower. Well, same thing happens in the market. What we have is a dual auction, and what we get is a record of human behavior. We get a record of how people feel about this market collectively. Now here also the high price and the low price match the top and bottom of the candle. And as many of you know who are familiar with candles, that doesn't always happen. And in fact, oftentimes the high price may be higher than the body of the candle. Now that difference, if we have that, is called a shadow. That line that you see there is called a shadow. I think at higher prices it represents sellers. And at lower prices, that difference, when the low doesn't match the body of the candle, there's a vertical line there. And I think that represents buying, a buying shadow. Now let's go through that concept. When the market opened at this price, sometime during its life, it did trade at that low price. Now, when it did, that means that the last price is lower than the opening price, and that would have been a red candle at that point. As the market started to move up, in other words, as buyers started offsetting some of that selling coming into the market, when it got to the opening price, what we'd see behind would be a shadow. That's what created that shadow. As buyers continue to compete, we now start trading above the open and we see a green candle that's being formed. Now, when this market traded all the way up to the high price, that green body would have extended all the way to the high price. But something happened there. And what happened there, we got high enough to find sellers. Now, it could be buyers selling to take profits. It could be new sellers enter that market. But what we see here is the market now starts moving down. And it's moving down because these sellers are now competing against each other and they're larger or moving more volume than buying. And we end up closing below that high. And the result is we leave a shadow which represents that kind of behavior. So shadows represent rejection and bodies represent the degree of acceptance or momentum. All right, so those are the principles that we're going to be using today. We also have a webinar coming up in August, and we're going to be looking at intermarket relationships, a different way of how those markets all kind of fit together. But let me show you my screen here because I want us to look at live markets, and hopefully that'll come up here in a moment so you can see that. Now let's talk about hopefully what you're looking at. And that is you're looking at 22 markets actually. I have one of them hidden. And these are the markets that I discuss every day in a video, which is posted on TradeStation. It's another resource that you may want to look at. There's a lot of good information at TradeStation and a lot of other commentary at TradeStation. There's opening market commentary that Don and I were just talking about, in fact. You want to take advantage of that. There's a lot of sources of information there, and you can compare how different people approach the market. Here, the intent is to give you an idea of my thoughts as I look at these markets. And I don't have them on here today, but you'll see red and green lines, which means bullish and bearish levels for me. These are not trade recommendations, but it gives you an idea of how someone's trying to identify a trade and how they're trying to manage that position as you see the red and green lines moving. So what we're looking at are stock indices. Up here at the top, we have the S&P, the NASDAQ, the Dow, and we also have the Russell 2000, which traded previously to the CME, and it's now back. And we also have the S&P 400, the mid caps. We'll come back and talk about those in a bit. And then we have currencies, the euro, the Swissy, Japanese yen, the second row, the Aussie dollar, British pound, Canadian dollar. Then we have interest rates, 5-year notes, 10-year notes, 30-year bonds. So we got the yield curve to look at. We've got gold. We've got silver down here in the lower left-hand corner. So it shows us the precious metals in terms of how they're setting up. And copper. And we had a pretty good day today in copper. Crude oil. We had some fundamental drivers on crude oil that we'll talk about. And then natural gas. So we have energy, and then we've got agricultural markets, soybeans, corn, and wheat. What I like this format, and TradeStation allows us obviously to create this, because it gives me a way to get a feel for how money is flowing in between these various sectors. In other words, when you look at these charts, where you see red candles, where do you see green candles? Is there a relationship between these complexes, these different sectors? And we'll find some cases there are relationships that you and I should be sensitive to. Because what we're looking at here for today and any day is we're looking at that shifting of capital. It'll go into a market or pull away from a market. Typically, if you see green candles, it would imply that buyers or that capital is coming into this market. If you see shadows, it would tell us again, as we talked about, the opposite form of behavior is coming into this market. So shadows on the highs would imply selling is coming into the market. Shadows on the low implies buying. And if we see shadows on the highs or red candles, it would imply capital flowing away from that market that you're looking at. So what we're looking at is, I believe, our capital flows. And what drives this, what creates these different charts, is the opinions, it's the beliefs, it's the attitudes that people have towards these markets. That's what we're looking at. And those oftentimes are formed by fundamentals. And we look at fundamentals, I break them into different categories. So as we go through some of the fundamentals that came out today, for example, where do they fit in? Are these economic fundamentals? Are these fundamentals that is an economic report that actually changes everything? Is it our economic report that shows us that down here in soybeans, that there's a lot of soybeans out there available for sale? And the result is soybeans coming down. Is it a report that's an anticipation report? That something may happen, hasn't happened yet, but the market reacts to it. It reacts to an opinion. It reacts to the potential that an economic report coming out could show something. We have GDP, U.S. GDP coming out on Friday. We have President Trump talking about, um, or at least considering, a ban on Venezuelan oil. Now, if you go down here to crude oil, just take that for a moment. Did crude oil move higher because of that? Or is that positive for crude oil? And to give you an idea, if the U.S. would ban Venezuelan oil, what that would represent, it's about 673,000 barrels of Venezuela oil comes to the U.S. right now based in July. So that would mean that we're going to see less crude oil from Venezuela and we'd see more crude oil coming from Canada because we buy more crude oil from Canada than any other country. So is that part of what's stimulating this? And now, is that reality? No, no, it's just considering concerns, the potential. Those are all fundamentals that usually do not drive a market. So when you hear those kind of things, be wary of it. And I think we have some of that built into the markets that we're looking at now. So when it comes to the fundamentals, we break them out that way. Now let's start talking about what we do see when it comes to the stock indices. Now the S&P had an up day, the NASDAQ struggled a bit. We had the Dow rallied. Remember, when it touches the high there, that would have been a green candle, but it failed. It pulled back a bit. We're seeing the Russell 2000, nice strong close. And you know, the Russell 2000, let's just take a moment and talk about that in case you're not familiar with it. It trades in zero 0.1 increments. You know, when you look at these indices for futures, you're not looking at dollars and cents. You're looking at an index level. And what we trade is the change in that index level. And when that index level changes, it has a dollar value associated with that level change. So this change trades in 0.1 increments. So 1450.50 is the current level. The next price up would be a 0.6 and the next level down would be 0.4. That 0.1 of change is $5 to give you an idea. Now, for all these indices, if you and I want to figure out dollar-wise, what does it represent? Well, only for stock indexes do we have this. We have an index multiplier. So for the S&P, it's 50. For the NASDAQ, it's 20. For the Dow, it's 5. For the Russell 2000 that we're talking about, it's 50. So if I take 50 times that number, it would tell me the dollar value of the contract that you're trading. All right, just in case you're not familiar with that. And what's interesting about the Russell 2000 is that it represents these smaller companies, medium-sized companies that can really have an impact on our economy and also can be a leading index. So we can look at this and we notice here that when the Russell traded up here, it traded above that previous high. In fact, let me just blow that up a little bit. You'll see that it traded above the previous highs that we have here. So a very strong day for the Russell in terms of its movement. And those companies are important because they can be very aggressive in terms of their ability to lead the indices. So it's definitely an indice that you want to follow, you want to pay attention to. Actually, let me just go back to that. And let's pull that up here so you can see it again. Whoop, wrong way. There we go. So what we can see in the Russell really is a sign of confidence. And it reflected, you know, we're in the earnings season, and some of that's reflected in the types of stocks that are reporting to give you a feel for what we're seeing here today. What's also interesting is structurally what we're seeing with that. Now in the video, I had a bullish level on the Russell, and the reason for that is the structure that we see here. If you look at this large green candle, I call that a benchmark candle. And if you look at the action that came inside this range. Did the market come down? Yes. How did it come down? If we think about behavior, was it one huge red candle like this? No, we had a rejection, we had shadows on the top, we had some selling, the market breaks lower. Remember, when it traded at the low, that was a red candle yesterday when it traded at the low. But as buyers came back in, we see that shadow on the bottom. So all these 3 days, it took them 3 days to cover what we did in one day. So when I think about the bias for this market, I think it's to the buy side. And what we're seeing here right now is the right kind of behavior. We want to close above that high. In other words, when you see a non-symmetrical pullback, that's what I call this. Excuse me, if we trade above that high, in the next 2 to 3 days, you should be closing above that previous high. And that's a swing high. In this case, we did it today. It's a good sign of strength. I don't look for that size of movement tomorrow. We do have some fundamentals coming out that's going to have an impact. Possibly the market may slow down to wait for those. GDP on Friday is one of those things. What's also interesting, all these markets trade almost 24 hours a day. So what we can see here in the Russell, it opened right at its low. You don't see a shadow on the bottom. Buyers came in and consistently moved that market higher through the Asian time zone because I'm based here in Chicago. So when I go to sleep at night, starting at 5 o'clock, actually, when I start looking at the markets later, that's Asia begins trading. And about 1 or 2 in the morning, Chicago time, Europe starts to trade. And what we see here is consistency of behavior. In other words, the market started out with buyers and it continued with that action. Now we had things that helped support it. In Germany, if you look at some of the German indices like the DAX, they had a pretty good day. German business confidence was at a record high level. So people have a good feeling about the market there. And Germany's the largest economy in the Eurozone. So we'll see that reflected not only here in these stock indices, we're going to see that reflected in the currencies. So we'll take a look at the euro here in just a minute. So we had, the German business confidence that had the market moving. Corporate earnings also, we had a number of larger companies that reported. They did pretty well. Alphabet did not, so Google kind of pulled the market down a tad bit. We have the Fed meeting starting, and we don't expect anything to come out of that. So those are potential drivers this week. My feeling about the Russell 2000 and this particular market segment is I am bullish on it. I do look for continued strength through the rest of the year, and I wouldn't be surprised to see this indice start leading the other stock indices. The angle of movement that we're seeing here, which gives us clues about that strength. Typically, if you're moving above 45 degrees, it's considered a positive or a stronger bull market. Here we're about 60 degrees. And I think this market has the ability to maintain that type of movement. If you go back to my previous videos, for example, and I think you can go back like 7 years, you could see when we've seen this market kind of leading the way, uh, which is really kind of an important thing I think to keep in mind when we're looking at that. But let's put that back. So let's sum up the stock indices. For these markets, so for the S&P, I am bullish on these markets. I do look for continued movement. We had a pretty strong day today. That's movement based on those earnings that really helped this market. As far as the Fed and the end of the week, the piece that's missing, and I think it's important for both of us to keep this in mind, is inflation. The Fed has three mandates: a full employment or try to get full employment, monitor the interest rates, and inflation, monitor inflation. And then also they're saying now to monitor the overall stability of the marketplace. But if you think about that, one of the key ingredients is inflation. If you look at the Fed policy over the last 30 years, which is when I started to trade. I paid attention to it in terms of when do they do it, how much do they do it, how often do they do it, so what's the quantity. Right now, I don't see the Fed doing anything at the end of 2 days here, at the end of these meetings. We really don't have that inflation component. A lot of people are saying, oh, don't worry about it. It's just temporary. Inflation's going to catch up. Well, it hasn't. And they've been saying that for a couple years now. So I still feel that that's a piece that's missing. The reason I'm concerned about that is that that is past Fed policy. And that if the assumption is that the inflation's always going to catch up, well, then the Fed may start increasing interest rates too fast. And here's the thing you want to keep in mind when you're looking at this indice and you think about inflation is this, that when the Fed increases interest rates, the market's going to react instantly. They'll react to every word that's being spoken, actually, as you know. But our economy doesn't feel it for 6 to 9 months. So if you have a large number of increases in interest rates, the discount rate by the Fed or the Fed funds rate, it has a tremendous impact as you go out in time, 6 to 9 months down the road. This year, I don't think we have to worry about that at all. But at some point, we may start seeing that behavior, and that's important. We saw it in the late 90s, and we also saw it leading up to 2007 from 2003. So S&P, I like the movement that we're seeing. Here, the market was trying to figure out what was going on. If you look at this June to the mid-July behavior, you have what I call an equal and opposite candles at the top and at the bottom. And these two candles together represent the same kind of behavior, or large shadow on the lows. So if you look above, we had nothing but selling above, and we had nothing but buying below with these shadows. So now we're starting to move. Excuse me. Let's see if we can maintain that momentum. I believe we can. Just one more thing I want to show you here. And let's just change the time frame here for a minute. And let's look at a weekly chart. And it gives you a broader point of view of how the markets are moving. Look at these lows down here. You know, what did we see? The market here, the market's falling out of bed, right? You see a big red candle. And at the end of the week, did anybody get out? No. At the end of this week, did somebody get out? Yes, because it traded at the low, and by the close of Friday, buyers came back into that market. 2 weeks later, boom, the market breaks to the downside again, and we see a shadow on the lows. That was a red candle, but by the end of the week, buyers came back in. So that may be a clue for you and I. Do they buy the break? And that's what we're seeing here. Look at that week. Talk about some volatility, huh? That's a presidential election last year. And what we're seeing there is that big break to the downside and buyers coming back in. So it's something for us to pay attention to. I think this is a very sustainable movement. The way we're moving up compared to the way we've been pulling back, it still favors the buy side. I know a lot of people are concerned about these levels, but we just haven't seen the consistent selling for me to be, on the bearish side of these markets. So I feel the same way about NASDAQ. If you notice, NASDAQ did not make a new high today. Let me just show you that. It was very balanced, and it goes back to earnings. Alphabet really didn't stimulate the market, and that has really a large impact on how the NASDAQ market's going to go. But I'm still looking for continued movement to the upside. This 5960, this higher range, that's the challenge for the market. Ideally, that we get a close above that by mid next week. That would be important, I think, for momentum. So for these indices, let me just show you the Dow so you have that too. A different kind of behavior. And if you think about, what are the stocks that make up the Dow? Very large companies. We're not seeing the same level of enthusiasm as we saw with these other indices. Here we saw stronger closes in the Russell. We saw stronger closes, or at least a strong close in the S&P. But the Dow, it's struggling. We're finding buyers at these lower levels and sellers at the upper levels, and I look for that to continue. I'm bullish on the indice. I'm bullish on this market, but I think it's going to continue to struggle throughout the rest of the year. So we are going to see it dragged along, but we're also going to see other periods of this sideways type movement, I believe, in that market. Now, let's take a look at that currency. First, let's just look at the currencies in general. Here's the euro, Swissy, Japanese yen, Aussie dollar, British pound, Canadian dollar. They did not behave the same way. What we did see, if you look at every one of them, it's either a red candle or shadows on the high, like here in the British pound. So what does that tell us? Let's open that up and let's take a look at the euro. What we're seeing here in the euro is this. We see a market that made a new high. Now, this market traded at its high during the European session because of what you and I were talking about. That, the German business confidence very high, that's positive for the euro, money flows right in there. But we see all these shadows, which imply that the dollar is getting stronger. If you're not familiar with currencies, let's just take a minute and talk about those markets. The numbers you see here on the side, those represent the dollar value of 1 euro. What we're looking at is the euro, and if nobody says anything about another market, it's the euro US dollar. Otherwise, they'll say euro yen or something like that. But if they don't say anything, it's a euro US dollar. It tells us the value of 1 euro in terms of US dollars. So here it was $1.12 to buy 1 euro. And if we went in the bank today to buy one, actually during the day, it traded above $1.17. So it increased 5 cents over that period of time. So what we're saying then is that the euro got more expensive, or in FX language, the euro got stronger. The euro strengthened. And since it's a euro US dollars, it's a relationship, it's a spread. That means the US dollar got weaker because the US dollar to buy a euro went from $1.12 to $1.17. The US dollar is buying less euro as the prices of the euro go up. So the dollar got weaker. The other thing you want to think about when you look at a currency chart or a spread chart is that the chart can represent the strength and weakness of the first variable. In this case, it's euro. So as this market moves up to the right, it means that the euro is getting stronger and the dollar is getting weaker because the euro is becoming more expensive. Now, here we're seeing the euro with a big green candle, but it failed to hold on to those highs. That implies a down day tomorrow. I think as the year completes itself, the second half of this year, I look for strength in the US dollar. Now, one of the things that happens when our stock market gets stronger, money flows towards our stock market. There are institutions that I deal with around the globe, and they're looking at that. They move capital around the world like you and I would move capital in between the stocks we hold in our portfolio. Only this happened to be doing it in between countries, and it happens to be a lot of money. But what we're seeing here implies a down day for tomorrow for that market. Let's put it back. So I think when it comes to the euro, when it comes to the Swiss, you're going to see something kind of similar. You didn't have the fundamentals driving that up. So if you notice here in the Swissy that the market did back off, it didn't have that fundamental boost, and that's why you don't see the shadow on the highs here. But we do see the market backing off. I do look for continued weakness in that market. Japanese yen is also another interesting market. It can also be used as a reserve currency. So when something happens around the world, what we see money flowing towards currencies and interest rates. And one of the areas that money can flow towards, cash-wise, is towards Japanese yen. It can also flow towards the Swedish kroner is another market people usually don't look at, but it can act as a reserve currency, meaning when money flows away from markets in general, it'll go towards those currencies and you expect them to go up. Well, here we see the Japanese yen got weaker. Yesterday we made new highs on selling, and today we got some follow through. It came down almost as fast as it went up. Tomorrow, I'm looking for a day that would give us a day similar to what you're seeing over here, unchanged to lower, but not a dramatic day down. Looking for a smaller range day, longer term. I think the behavior that you and I have seen here over the last, um, well, let's say since mid-May or March, what we're looking at here, or let me do it this way. Maybe that'd be a better way for you to see it. What we've seen here for this year, this action, I don't think is going to change much this year. Japan, we're seeing some signs of positive things happening there economy-wise, slowly, but I think this sideways move that we're going to see here is going to remain. So from 94 cents down to 86 cents, that kind of plenty of opportunity from trading, but I think the sideways move is going to continue in that market. So it's somewhat of a neutral stance when it comes to Japanese yen, but let's talk about our friend the Aussie dollar. Now, this market has a whole different set of dynamics. It's a resource-based economy. It's got a little over 20 million people, and it's also considered a commodity currency, and it's because the main thing it does export are its resources. The number one seller of iron ore in the world is Australia, for example. And they're right on top there with wheat and coal and other wood pulp, other things they have to sell, precious metals, for example. Biggest customers, China, Japan, Korea. So we watch those countries. If they're having economic issues or problems, we're going to see it reflected here in our friend the Aussie dollar. Now, you can see that weakness. When China slows down, this economy is going to feel it as well. The RBA is meeting this week, and people are saying, what are they going to be doing? I don't see them doing anything, actually. There's no reason for them to change the discount rate, I think, at this point, when you look at the economy overall. Right now, it's at 1.5%. That's historic lows uh, for Australia, by the way. You'll also see a relationship between Australia and Japan in terms of currencies. People would take a loan in Japan for let's say a quarter of a percent. So now you and I borrow Japanese yen for 90 days. We take that money, we convert it to US dollars, to Aussie dollars. We put it in a bank account in Australia and make 1.5%. So it's a 1.25% differential. At the end of 90 days, we take our deposit at the Australian bank, convert it back into yen, and then deposit and pay off our loan. That's a carry trade. The challenge, it's also called interest rate parity if you think about the dynamics that's happening here. But the challenge, and you probably already noticed it, is when you convert the Aussie dollar back to Japanese yen. If the Australian dollar gets a lot stronger than the yen and you get less yen, you may not get enough yen to pay off that loan. So that risk is hedged. And what we'll see when you hear people talking about the carry trade is unwinding, that's what they're referring to. And oftentimes Aussie dollar, Japanese yen is a common carry trade. This movement that you're seeing here, both buyers and sellers are present. You see shadows on the bottom, you see shadows on top. It's a very neutral position as they go in to the RBA, their central bank's announcements. So we see the market positioning itself from a neutral point of view. However, if you and I look at how did it get up here? What was the last strong form of behavior that you saw here? Well, it's that big green candle, I think. And that has a bullish bias. So I am bullish on this market. We're seeing signs of change increasing a little bit in China. That creates demand for the resources in this country. And I'm bullish on that as we go into the rest of this year. So let's also take a look at the British pound. Wow. This market, it has such challenges. The Brexit, we think about that, the challenges coming up for that market. And if you look at most of this year, look at how we've moved here. We've just basically been in a large sideways move. The bias is for stronger levels, and maybe as people calm down and feel more comfortable with this concept, we'll see some strength. But there's a lot of unresolved issues from trade, from a trade point of view. Uh, our friends here in the UK, there's 1,100 trade agreements they're going to have to renegotiate. And who are they representing? Do they represent Scotland and Northern Ireland? Ireland, do they? And you have to hire them also. They don't have all those trade negotiators. We hear talk about it right now. Today in the news that the UK and the US are just talking about, when that moment happens, what can they do together? They want to maintain that relationship. 5,000 laws have to be taken off the books in England, in the UK. If you're a EU resident and you're now working or living in the UK, what happens after this? If you're a retiree from the UK living in southern Spain and the Brexit does happen, what happens to your medical benefits? If you look at soccer in the UK, the most profitable soccer league in the world is in the UK. 19 of them teams are in Britain, one's in Wales, and over 20 players are from the EU. What happens to those players? Do they get visas? So there are some, uh, even though I'm talking about that, but it does have serious implications. If you're a bank and you have operations in the city of London, what are you going to do there? You're going to keep it there? We hear more and more institutions looking at Frankfurt, looking at the US, looking at other European countries. So there's a lot of uncertainty surrounding this, and that's not going to change anytime soon. The bias, I think, for the rest of the year is for a move to the upside. I'd be very surprised if we trade above 132. I really look for a range-bound market like we're seeing here to continue because of that fundamental cloud that's hanging over that market. Now let's look at one more resource economy, and that's our friends in Canada. If you look at the loonie, and the loon is a bird on the Canadian dollar, by the way, a water bird, and they call it the loonie for that. But all right, what a move, huh? The biggest resource for that economy, it's crude oil, and we are the biggest customer for that crude oil. So the relationship, when you think about our friends in Canada, think about crude oil. Take a look at what's going on with that, and we will in just a bit. The issue for us, a nice strong move here. Here's your non-symmetrical pullback again, just like we saw in the indices. Um, it's the way we're moving higher. Is this maintainable? Is the market getting stronger? Well, it's moving up in prices, but the issue for you and I is how is it moving higher? And today, a very neutral position is the way it finished. It's a market waiting for information. And let's put it, and for this market, I'm mildly bullish on it. It's hard for me to be super bullish because of what's happening right down here. Let's just jump down here and take a look at crude oil. Now, I am not bullish on crude oil. And the reasons, unless we see changes, uh, the reason is just supply and demand. If we think about what's going on, OPEC said we're going to cut production by 1.8 million barrels a day. And they kind of have. Saudi Arabia, well, they led the way. They're 100% compliant. If you look at Iran, they're about 55% compliant. And if you go back to my previous videos, when they first announced this at the beginning of the year, I did not have much confidence in it, and I still do not. OPEC does not have a good track record of maintaining this type of control over its members. Now, remember, we were talking about Venezuela. If they get throttled back from the U.S., do you think Venezuela is not going to look for some other place to sell their oil or increase their production when they have, potentially with riots in the street? If you were them, we'd probably produce more crude oil too. Nigeria, if you look at some of those countries, they're now hopefully at a level they're not going to produce a lot more. They're not going to increase their quota. Saudi Arabia, and what's caused this move today, Saudi Arabia said they're planning on increasing their production cuts by 3%. Well, when you have a tremendous historic levels of supply globally, we don't have the economies of countries heated up enough to consume this extra supply. So until that supply is gone, you can cut a lot of production. It still has to be absorbed in our system. And I haven't seen anything in a big way that has happened. So it's hard for me to be super bullish. Would I be long this market? Yes. And I get emails from people regarding this from my videos saying you say you're bearish, but you're long. Price dictates what we do, not my opinion. My opinion is just that. It's an opinion. What puts money in my pocket and takes money out is price. So I want to pay attention to what price is doing. And that really forces me to take a trade. Uh, I don't want to think about what I want. I want to think about what the opportunity is the market's giving me. I believe as a trader, that's our job. So we're seeing crude oil move up. I'm not looking for a big day up tomorrow, about a third of this range to the upside. Could crude oil prices go higher? Yes, but it's on the anticipation of supplies coming down globally. And that's a big if. So that's why I'm very guarded about being super bullish on crude oil. And I don't see that changing anytime soon. Okay, let's just finish energy, and that's natural gas. Natural gas, thing you want to remember with this market, one, it burns 60% cleaner than fossil fuel than we would use for a coal-fired plant for producing electricity. A third of this uh, commodity goes towards electricity production, a third goes for industrial production, a third goes for us to heat our homes and cook our food. And we've had high temperatures. We have drought conditions in some parts of the country. I expected prices actually to be above 315 by now. Hasn't happened. And what you see here, look at that. Look at 310. What do you notice about 310? They're selling 310. What do you notice about 285, 283? They're buying at these lower levels. Right? And right now, we just have a potential transition. It implies over the next 2 to 3 days, we should see stronger prices. I think the potential for a bullish market in natural gas is possible before year end. So for the next 6 months, I want to think about that possibility for this market. So in this market, I am bullish on natural gas. The issue though is we got to get a close above 310. Here's the deal. If you and I aren't together with another webinar by then, if natural gas gets up to 310 and it does it with tiny little candles or something like this with the shadow on the high or like these over here, see that? That's not a market with moving with confidence. If it trades above 310, we should be closing around 317. If we do that, then I would say we have a chance for movement, further movement. If we don't, then I think we're going to continue a sideways move here for natural gas. Let's also go back up and take a quick look at interest rates. I think they're beautiful. I'm going to pick the 10-year notes just for us to go over that. It makes sense. If our economy is stronger, if you think about it this way, one of the typical ways that money comes out of the stock market when it comes out, one of the places it goes is interest rates because they feel they want comfort. And that's, a maybe a reduced return, but a safe place to put the money. So if that belief persists that the stock market's weaker, you look for strength here in the 10-year notes. And what you're looking at is the inverse relationship of price and interest rates. So when you hear interest rates are going up, it means that prices, that's what we trade in the futures market, price is going down. So interest rates, the anticipation is going up right now. I look for I'm bearish on the 10-year notes. I'm bearish on the 30-year bonds, the whole yield curve. I think our economy is still strong. I think we still have positive things happening. So I'm looking for the stock market to get stronger, as you and I discussed. That would imply weaker prices here for the futures markets. So I do look for that continued movement to the downside. And for tomorrow's action, I'm looking forward to trade between 125.24 down to 125.08. That range right there, about a 16 tick range, but that's $500 is the value of that, to give you a feel for that. That's kind of what I would look for in this market. I'd like to see this continuing lower because it supports what we're thinking about when it comes to the stock market. Now, let's take a look at a market that's also another barometer that you and I should pay attention to, and it's our friend, Mr. Gold. What we see here with gold is a market that moves on uncertainty. If we have inflation, which we don't, if we have a weaker dollar, which we did, um, we expect gold to start moving. If we have uncertainty in the world, any major things that happen, we expect that capital to flow towards gold because it's considered a value investment, gold and silver. What we're seeing here is a market that is backing off. As the dollar gets stronger, I'm looking for this to continue to get weaker. Long term, I think we need other drivers to come into play to really cause this market to move up. So I'm very cautious on the long side when it comes to this market. I think we have to pay attention to how it does behave. If we start closing below 1238, 1237 right down here, I'm looking for further movement to the downside in that market. So I think we could easily trade in a sideways move unless we have something to stimulate this market to give us a strong move. I'm looking for a sideways move as we finish this year out, meaning 1260 down to 12 even. Again, a tremendous opportunity for trading, but I don't see a strong move coming up in that market. But check out a market that I am bullish on, and it happened to move up today. But if you go back to the videos over the last few days, when it was down here or back here, this is a market that I do feel represents a tremendous amount of opportunity to the upside, especially if China's economy increases. China consumes 48% of the copper supply globally. They consume enough copper to wrap a copper wire, around the world 100 times a day. So to give you an idea. And their future demand for copper is going to be increasing. In the United States, when we build a new house, that's about 400 pounds of copper. So when we look at housing permits and housing starts, that can be an important demand here for that. If you look at the steel industry and the chemical industry, um, they also, I mean, not steel, the auto industry can have a tremendous impact on copper. Use it 40 to, well, actually, it's 50 to 90 pounds of copper per vehicle, depending on the vehicle. So right now, what do we look for tomorrow? I'm looking for a range much smaller than what you're seeing here, about a third of this range. I am bullish on it longer term, and I think this is a market that we want to pay some attention to from that side, from the long side, I think. Now let's talk about ags, and we'll be finished here. The soybean market is a market that is really struggling. We have some really crazy weather conditions, and we also have had some floods. Farmland has flooded, but what you want to keep in mind, and this happened in 1993 to me, because I felt that soybeans has to continue to go up. primarily because I was long some soybeans and I got out and I was looking for a place to get back in. But I and my wife and I went down to the Cahokia Indian Mounds near St. Louis, and we were just talking about that. The rivers were flooded, farms were flooded, little towns were flooded. It was terrible. I came back with such a bullish opinion that I was always looking for an opportunity to buy soybeans. But the market's right. And soybeans for the rest of the year after I got out continued going lower because other parts of the country did have ideal growing conditions. We only lost about 10% of our soybean crop. So it wasn't the disaster that I envisioned. And that's why I think it's important that you and I always keep that in mind. Am I looking at the market the way I want it to support my position, or am I looking at the reality of what's going on? But for soybeans, it's a mixed bag. This market could easily be to either side. I'm not super bullish or bearish this market. Right now, it's in a bearish mode. We're looking for continued lower prices, but so much can happen. You see the same thing here in corn. That's our largest crop. It's over $70 billion a year is generated in the corn market. And what we're looking here is a market that's struggling. See that sideways move here? We just don't know enough yet to really cause a strong, continuous directional move in that market. We get bits and pieces. And until we harvest it, until we see what we really have and the quality of that product, we really don't know. And that's going to be in the fall. So a continuation of a sideways move in corn, also in wheat. The global situation for wheat is the dynamics are different, and we are seeing some weakness here. I thought the strength that we had here previously might continue because it looked like supplies could be so tight globally, but that so far is not the case. So continued weakness in this market, 432, I think has got that potential to the downside, but I'm looking for that broad sideways move as we complete the rest of this year until we get to September, October time period. So that's a few thoughts when it comes to these different markets. I hope you have some ideas of tools that you can use and some thought processes when it comes to looking at these candle charts and also the fundamentals that drive the market. I try to understand those so I get an appreciation of the dynamics, but what really determines whether I want to buy or sell a market is price, because again, that's what's going to put money in my pocket and take money out of my pocket. So let's go back here to our slides. And I hope today gave you some things to think about. Let me just see if there's any questions I need to answer. Um, okay, so people can look at that. Good. All right, I think we're good there. Well, I want to thank everyone for sharing part of your day with me. Again, I hope you've gotten some things to think about. I wish you all the very best and much success in your trading. And Don, thank you for being my guide, taking me through these markets. I appreciate you setting everything up for me today and look forward to being with you again next month.